Welcome back to Investing Talk Podcast.
Today we're looking at Joby Aviation. The big question is it a good time to buy now?
We want to hear from you. Subscribe, like, and comment to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. When we discuss Joby Aviation, we are looking at what the sources define as, well, pretty much the undisputed frontrunner in the whole eVTOL sector.
Right, that's the electric vertical takeoff and landing air taxis.
Exactly. And we're not talking about some, far-off concept. This is a company aiming to deliver on-demand urban air mobility. They want to manage everything themselves, the app, the service, the whole thing.
It's a really compelling vision, isn't it? I mean, this is potentially game-changing tech, completely changing how people move around cities quickly.
It is, but, and this is the big but, right now it's a pre-commercial company.
Meaning it's running on investor optimism, basically, not actual profits from operations.
Precisely. So before we even get into the cool tech stuff, we really have to look at the financials. How bad are the losses?
Yeah, how red is the ink?
Okay, well, it's significantly red, but you need the context here. Our fundamental analysis showed this classic paradox you see with innovative companies.
Okay.
So the problem first, revenue is tiny, like negligible. Trailing 12 months, just $98,000.
Wow, okay. Practically zero.
Pretty much. And the net losses are, frankly, staggering. Negative $797 million TTM.
Oof. Almost 800 million down.
Yeah, and that reflects the huge but necessary costs.
Yeah.
R&D, getting through that incredibly expensive certification process. It all adds up.
Right, that kind of loss figure. That scares off a lot of investors, especially if they just look at the bottom line. So how are they even sustaining that burn rate?
And that's where the whole investment story shifts. It leads right to their main strength right now, liquidity.
Okay.
Despite those massive losses, Joby pulled off a huge equity offering in Q3 2025, raised $591 million.
Wow.
Yeah, it was a massive vote of confidence from the market. And it boosted their available cash to, get this, $1.6 billion.
$1.6 billion. That's an incredible war chest.
It really is.
Let's make that practical for listeners. They're burning, what, roughly $200 million a quarter based on those TTM losses, give or take.
What's a fair estimate, yeah.
So what does $1.6 billion actually buy them in terms of time?
It buys them runway. A lot of it. Based on current burn rates, that cash gives Joby about 8 full quarters.
2 years.
2 years of operational runway. And that's absolutely critical right now. It means they don't have immediate worries about just staying afloat.
Right.
Their focus isn't raising more cash tomorrow. It's hitting those certification milestones and delivering on the tech. They have the financial cushion to focus purely on growth, on scaling, on regulation.
So that big capital raise, even though it caused some short-term dilution pain maybe, it fundamentally shifted the risk, didn't it? From, are they going to survive, to, can they hit their regulatory targets on time?
Exactly. It shows the market is betting really heavily on their execution. They've managed to combine that strong market belief with, actual financial resilience.
Okay, so the runway is there. But cash just buys time. It doesn't guarantee success. What are they building that gives them an edge? We need to look past the cash pile and at their competitive moat.
Right.
They have that first mover advantage in talking to regulators, but what about the technology itself?
Well, the tech edge is kind of twofold. And one big piece involves a really key partnership. Joby was named NVIDIA's exclusive launch partner for the IGX Thor platform.
NVIDIA. Okay, that's a big name. Why is IGX Thor so important? Is it just about faster chips?
It's way more than just processing power. It's about getting certified and de-risking the whole path to autonomous flight.
How so?
The IGX Thor platform is specifically designed for what's called high-integrity computing. Think safety critical systems. For the FAA, autonomy is probably the single biggest hurdle for certification in this space. So Joby integrating NVIDIA's platform means they're using proven, super reliable computing architecture. It's designed for the kind of safety levels the FAA demands. It basically validates their whole automation stack, shows regulators the systems are redundant, they're safe.
So it helps them potentially leapfrog competitors who are maybe struggling to build that kind of safety critical system from scratch internally.
Precisely. It gives them a real head start in that regulatory conversation, which, as we said, is kind of the main event right now.
And their business model is built around this tech, right? They're not just planning to sell the aircraft like, say, Boeing or Airbus might.
No, definitely not. They're aiming for end-to-end ownership. They want that recurring revenue stream from operating their own air taxi service run through their own app.
Sort of like a flying Uber, but they own the cars too.
Kinda, yeah. Like a mashup of Tesla and Uber, maybe, but for the sky. This integrated approach means they control everything: the customer experience, maintenance, scheduling, and really crucially, all the operational data, which is incredibly valuable.
Right. If they actually get to scale, that recurring revenue model could be way more valuable than just being a hardware maker.
Exponentially more valuable, yeah.
Okay, let's switch gears hard now to the stock itself, the technicals, investor sentiment. Because you've got this huge cash infusion, massive tech potential that usually equals volatility.
Oh, definitely.
The stock's had an amazing run, right? Up nearly 200% over the past year at one point. What's the recent price action telling us?
Well, the recent story is pretty classic. You had some profit-taking mixed with nerves about that equity offering, the dilution.
Sure.
It hit a 52-week high around $20.95 earlier in the year, but then pulled back into that $16 to $17 range after the offering was announced. People who were sitting on huge gains used the news as a reason to lock some in.
Okay, but that pullback may be painful for some holders. It didn't break the overall trend.
No, it seems the momentum is still there, technically speaking. The outlook is still bullish. The stock's holding above both its 50-day and 200-day moving averages.
Which is usually a strong sign.
It is. It signals sustained bullish momentum, suggests institutions might still be accumulating. Our sources project a likely trading range for the next 3 months, somewhere between $15 and $21.
15 to 21, that's a pretty wide range. And the beta I saw is sitting at 2.52.
Yeah, high beta.
For anyone looking at that number, 2.52, this isn't exactly a safe, stable investment. It sounds more like speculation. How do you advise someone who just can't stomach that kind of wild swing?
That's a really important point. A beta of 2.52 means, roughly, if the S&P 500 moves 1%, Joby is expected to move 2.5%. Up or down.
Whoa!
That high volatility is just part of the deal with pre-revenue, high-growth stocks, totally dependent on regulation.
Yeah.
If you're a conservative investor, honestly, it probably isn't the stock for you right now. But for investors looking for significant growth, that beta also signals massive upside potential if those catalysts hit on schedule. The risk is definitely high, but the potential reward is why people are interested, despite the volatility.
And the analysts seem to agree.
Yeah, the sentiment there is strong. We looked at 6 analyst ratings, and they're overwhelmingly bullish. Consensus is a buy.
Okay, let's drill down on those catalysts then, because for a stock like this, where everything hinges on future events, the next 90 days or so feel critical, make or break almost. What are the key things investors should be watching?
Right, there are 3 big ones coming up. First is the earnings report, expected around November 5th or 6th, 2025.
And nobody's looking for revenue there, obviously?
No, not at all. Investors will be hanging on every word about the cash burn rate, sure, but mostly they want updates and guidance on the timeline for Phase 4 of FAA certification.
That's the big one.
That update really sets the tone, the expectation for the rest of the quarter.
Which leads right into catalyst number 2, the FAA certification milestones themselves. This isn't just one event, right? It's a whole process.
Exactly. It's a marathon, not a sprint. Getting that type certification specifically, Part 23 for the aircraft itself, is non-negotiable for the target commercial launch in late 2025.
So any positive news on that front?
Any positive updates suggesting they're on track or even ahead of schedule could inject huge optimism into the stock price almost immediately. The whole company is basically racing against that regulatory clock.
Okay, and the third catalyst is more about market mechanics, less about Joby specifically.
That's right. Pure market structure stuff that can cause volume spikes. We're watching for the Russell Nasdaq ETF review on December 2nd. Rebalancing there could force big funds to buy or sell large blocks of stock.
This is based on index rules.
Exactly. Then, early next year, around January 5th, 2026, we get the new institutional filings. That shows us where the big money, the hedge funds, the pension funds, place their bets at year-end. It gives you insight into smart money positioning.
And floating around all this, you always get the speculative buzz, the rumors.
Oh yeah, always. Especially with a tech leader like Joby.
What are the whispers?
Well, they're just whispers, unconfirmed of course, but the sources mention constant links. The perennial favorite is some kind of partnership with Tesla. Maybe using their battery tech, maybe something on the autonomy side, who knows?
Interesting.
And then there's the M&A angle, because Joby is seen as the leader. They're always talked about as a potential takeover target for the big legacy aerospace companies, your Boeings, your Airbuses, maybe they decide it's cheaper to just buy the leader than try to build it all themselves.
Right, and that M&A chatter alone can add volatility. But okay, let's bring it back down to earth. Balance the excitement with the cold, hard risks. What could actually derail this whole bullish picture?
The number one risk, the one that underpins everything else, is regulatory dependence.
The FAA again.
Always the FAA.
Yeah.
It's not just about potential delays. It's the risk that the FAA, because this is all so new and safety is paramount, might suddenly impose new, tougher requirements that could push the timeline back significantly.
Which hits the valuation and could force them to raise even more money later on.
Exactly. Then there's execution risk. That $1.6 billion buys time, like we said, but it doesn't magically solve the complexity of scaling up.
Right. Going from a working prototype to a reliable, scheduled air taxi service operating across multiple cities, that's a massive operational challenge.
It's huge. You need specialized manufacturing at scale, complex new maintenance procedures for electric aircraft, building the ground infrastructure, the vertiports in crowded urban areas. It requires flawless execution on so many fronts.
And you mentioned dilution risk earlier. That hasn't gone away just because they have cash now, right?
No, it's always there in the background. Until they reach profitability, future growth might require more equity raises. And each raise, even if necessary, dilutes the ownership stake of existing shareholders.
Okay, and maybe a final risk, the broader market itself.
Yeah, the whole eVTOL market, urban air mobility, it's still really nascent. Even if Joby does everything right, hits all its targets, is the market actually ready for mainstream adoption in late 2025 or 2026?
The infrastructure needs to be there, public acceptance, the cost model needs to work. The timing for widespread adoption is still pretty uncertain.
That uncertainty is a big reason the beta is so high. You're essentially betting that this disruption is going to happen relatively soon.
Okay, so let's try and synthesize all of this. We've got the $1.6 billion runway, the NVIDIA tech partnership helping with regulation, these critical near-term catalysts, but also significant regulatory and execution risks. What's the final thesis? Is now a good time to buy?
Our analysis still points to an overall bullish rating. We landed on an 8 out of 10.
Still an 8-10 despite the risks.
Yes, because the company is strategically very well positioned. They are exceptionally well funded for the near term, and they really are the innovation leader in this space right now. That combination of the upcoming earnings report, the ongoing FAA news flow, and potential institutional trading catalysts, it makes a compelling case for potential appreciation in the next, say, 90 to 120 days.
So who is this stock actually suitable for right now?
We see it as attractive for two main groups. First, maybe the shorter-term trader, who's looking to play the momentum, the volatility, heading into those November-December catalysts. Potentially buying the rumor, selling the news.
Okay.
And second, and maybe more importantly, it's attractive for long-term investors, people who really want significant exposure to this potentially huge, disruptive urban mobility market and who are comfortable accepting that high level of regulatory risk that comes with it.
All right, here's the concluding thought then. For all the fascinating discussion around Joby's advanced technology, their battery systems, their autonomous flight software, ultimately, the fate of this company, certainly in the near term, seems to rest almost entirely on the speed and the decisions of the FAA. This complex technology investment is, fundamentally, a bet on a regulatory timeline.